Sign your home over to your child while you're still alive, and the IRS can hand them a $90,000 tax bill on a gift you meant to be free. Not from a bad investment. Not from a mistake on their end. From a decision you made with the best intentions, because you wanted to help them, or because someone told you it would make things easier. Not the house that cost them. The tax bill that came with it. Not the gift that hurt the family. The rule nobody explained before you signed. And it does not stop at one bill. That capital gains sale can push your child's income over a Medicare threshold and raise her Part B and Part D premiums 2 years later. One deed transfer. Multiple years of ripple. The difference between gifting a highly appreciated home and letting your child inherit the same house can be $60,000 to $90,000 in federal taxes. Same property, same family, same eventual sale. One decision, made at the right time, and that bill simply does not exist. Part 4 is the one most families never reach in time. 3 moves that protect the heir without triggering any of this. In the next 15 minutes, you will see exactly how the 2 key tax rules work, why the gift tax conversation leaves the real problem wide open, and what to put in place before anyone's name goes on that deed. I am your guide to real-world retirement decisions, the math that should have been in that estate planning meeting, but rarely is. Before we get into Part 1, if breakdowns like this are worth your time, hit like and subscribe, so the next one lands in front of you without you having to search for it. Part 1. The tax bill hiding inside the deed. Here is the example that makes this concrete. A couple buys a home in 1992 for $180,000. Today, it is worth $780,000. $600,000 built over 30 years. They gift the house to their daughter now. Her basis, the IRS's starting point for calculating her taxable gain, is $180,000, the number carried over from her parents' original purchase. She sells. The gain on her tax return, $600,000. At a 15% federal long-term capital gains rate for illustration. The actual rate depends on her total income, filing status, and state. That is $90,000 owed to the IRS. On a gift, from people who were trying to help her. Same house, same daughter, same family. But she inherits it instead when it is worth $780,000. Her basis steps up to $780,000 on the date of death. She sells. Her gain, $0. Her federal tax on that sale, $0. The $90,000 bill does not exist. That is the rule this video is about. And here is how it actually works. When you own a property and eventually sell it, the IRS starts with one number to calculate your taxable gain, basis. Basis is your original cost, adjusted upward for any capital improvements you made along the way. A new roof, a kitchen remodel, a finished basement. All of those add to the basis and shrink the eventual gain. The formula is simple. Selling price minus adjusted basis equals taxable gain. When you give the property to someone else, Section 1015 of the Internal Revenue Code says the recipient's basis is the donor's adjusted basis at the time of the gift. What it means in plain terms, the person who receives your home as a gift inherits your cost history. Not the value of the home on the day they received it. Not the current market price. Your original purchase price, adjusted for whatever improvements you made. Every dollar of appreciation that built up while you owned the house converts directly into their taxable gain. Waiting inside the deed. In our example, suppose the couple added a garage addition years ago and their adjusted basis is $200,000. They gift the home to their daughter today when it is worth $780,000. Her basis, $200,000. Her potential gain if she sells at today's price, $580,000. Federal capital gains tax at 15% in this illustration, $87,000. If her total income that year runs higher, the rate can reach 20%, with a net investment income surcharge on top. State capital gains on top as well, depending on where she lives. There is one partial offset worth understanding. If the daughter moves into that gifted home and lives there as her primary residence for at least 2 of the next 5 years, she can use the Section 121 exclusion, up to $250,000 of gain sheltered if she is single, up to $500,000 if she is married filing jointly. That helps, but it does not erase the problem, because the basis she carried over from her parents is still the starting point. The exclusion shields a portion of the gain above that starting point. It does not change the starting point itself. And for a home with $600,000 in appreciation, even the married exclusion of $500,000 leaves $100,000 of taxable gain, $15,000 of federal tax at 15% before state taxes. And if she keeps the home as a rental or sells without ever meeting that 2-year residency requirement, the full exposure is on the table. No exclusion, the entire gain taxable. There is one more dimension most families miss. A large capital gain in the year of sale does not just trigger capital gains tax. If the gain is large enough to push your daughter's modified adjusted gross income above certain thresholds, and she is on Medicare or within a few years of enrolling, it can raise her Part B and Part D premiums 2 years later under the IRMA look-back rule. The gain from her parents' gift ripples forward. Part 2. The rule that can make the same house tax-free. Section 1014 of the Internal Revenue Code does something that looks almost too good to be true until you read the actual statute. When property passes from someone who has died to their heir, through a will, through a revocable living trust, through a beneficiary deed, the heir's basis is set to the fair market value of the property on the date of the decedent's death. Not what the decedent paid. Not the adjusted basis carrying decades of appreciation, the value on the day it was inherited. This means every dollar of appreciation accumulated during the decedent's lifetime is wiped from the tax ledger. The gain that existed for 30 years, real economic gain, real appreciation, real dollars, simply stops being taxable gain the moment it transfers through an estate. Back to our couple. They keep the house. They pass it through their estate when the house is worth $780,000. Their daughter's basis, $780,000. She sells it the following month for $780,000. Capital gain, 0. Federal tax due, 0. The $600,000 in appreciation built over 30 years of ownership is gone from the tax record, permanently and legally, assuming she sells near the date of death value before the property appreciates further. Here is one detail worth noting for couples in community property states. The 9 standard community property states under IRS Publication 555 are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In those states, when one spouse passes, the entire value of community property, including the surviving spouse's half, generally receives the stepped-up basis. Both halves reset, not just the decedent's share. For a married couple in California with a highly appreciated home, that double step-up can be an even larger benefit than it would be in a common law state where only the decedent's interest steps up. Alaska has a separate elective community property law. Check with an estate attorney on how it applies in your situation. This rule has been part of the Internal Revenue Code since 1954. Congress has considered limiting or repealing it more than once. It has survived every time. As of today, it is there, available to any family that allows property to pass at death rather than through a gift. Part 3. Why no gift tax due is not the same as no tax bill. This is where most conversations about giving a home to your children go wrong. When a parent raises the idea with an attorney, the attorney often leads with the annual gift tax exclusion. In 2026, that exclusion is $19,000 per recipient. Give more than that to any individual in a calendar year, and you are required to file a Form 709 with the IRS to report the gift. On a house worth several $100,000, that Form 709 is clearly required. But here is what most families hear next. You probably will not owe any gift tax. And in most cases, that is true, because the IRS also gives every American a lifetime gift and estate tax exemption. In 2026, that exemption is $15 million per person, which means a married couple can transfer up to $30 million in combined gifts and estate assets before owing $1 of gift tax. A home worth $780,000 is well inside that number. You file the 709, it is counted against the lifetime exemption, and no tax is due today. The family hears no tax due and assumes the gift is clean. It is not clean. The carryover basis problem does not care whether gift tax is owed. The basis travels with the property whether or not a 709 is filed, whether or not the lifetime exemption absorbs the transfer, whether or not anyone involved is aware of Section 1015. The gift tax question and the capital gains question run on completely separate tracks. Closing the gift tax question leaves the capital gains question entirely open. The gift tax exemption saves the family from writing a check to the IRS today. It does not save their daughter from the tax bill when she sells. Those are two different tax events, two different code sections, two different moments in time. Conflating them is the mistake that costs families tens of thousands of dollars, years after the deed is signed. Part 4. When gifting still makes sense, and 3 moves that work better. There are 3 situations where gifting a home during your lifetime is the right decision. First, when the property has not appreciated much. If you bought a vacation cabin 5 years ago for $400,000 and it is worth $430,000 today, the carryover basis issue is minimal. The gap between what you paid and current value is $30,000. The future capital gains exposure, even without a step-up, is manageable. When the appreciation is small, the case against gifting is small. Second, when your estate is large enough that estate tax is a genuine concern. With the 2026 exemption at $15 million per person and $30 million per couple, very few American families face this. But for those who do, removing an appreciating asset from the estate can reduce the eventual estate tax bill. If your situation puts you near or above those thresholds, you are already working with an estate attorney and a CPA who know these trade-offs. The decision belongs in that conversation. Third, specific Medicaid planning scenarios where gifting a home may affect eligibility for long-term care coverage. That topic involves a 5-year look-back period, state-by-state variation, and rules that can delay or block coverage if not handled carefully. Do not attempt that path without an elder law attorney who practices in your state. For the majority of families, the answer is simpler. Keep the property. Let it pass through your estate. Here are 3 vehicles that accomplish that without a gift. A revocable living trust lets you put the home inside the trust while you are alive, name your daughter as the beneficiary, and have it transfer to her when you die, bypassing probate, moving cleanly and privately. Because you still own it for tax purposes when you die, the property is included in your estate for basis purposes and the step-up applies. Your daughter gets both the speed and privacy of the trust transfer and the zeroed-out basis she would have received through a will. A transfer-on-death deed, available in many states but not all, lets you record a beneficiary directly on the deed. The daughter's name is on file. At your death, the property transfers automatically. No probate, no court. And because you retained ownership until death, the step-up still applies. Check whether your state allows this instrument. A simple will achieves the same tax result through a slightly longer probate process. The step-up is the same. Probate is slower and costs legal fees, but the capital gains outcome for your daughter is identical to the trust or the TOD deed. What all 3 have in common: the property does not change hands until death. That is the single condition the tax code requires to trigger the inheritance rule and reset the basis. The one thing worth carrying out of this video: a gift is not free. Every dollar of appreciation you built over a lifetime travels inside the deed when you sign it over. Your heirs do not just inherit a house, they inherit your basis. And the distance between that number and the eventual sale price is their tax bill. Keep the property, pass it at death, and that bill does not exist. Before you sign any deed, before you talk to a title company, before you add a name to the ownership documents, ask an estate attorney one question. What is the step-up basis analysis for our specific home and our state? That conversation costs far less than the tax it prevents. This is not financial advice and not legal advice. These rules depend on your state, your estate size, your heir's own income and plans. This is education. The decision belongs in a conversation with a qualified estate attorney and a fee-only fiduciary who know your full picture. If this gave you a number worth sitting with, tap like. It puts this in front of other families making this exact decision. Subscribe if you want to keep doing the retirement math together. And in the comments, type the word basis. It tells me this reached you, and I read everyone. Retirement is not about the most generous move. It is about the most informed one.